a Weibo, and then a Charles Schwab. Each one of this trading platform individually tracks your PDT, meaning Robinhood has its own limits for 3-day trades for 5 business days. Webull has its own 3-day trades for 5 business days. And Charles Schwab has his own 3-day trades for 5 business days. This means collectively, with 3 accounts, now you do have 9-day trades for that same 5 business days. Robinhood is not here telling Weibo like, oh, Khadija just made 3-day trades, don't let her trade anymore. Or Weibo is not telling Charles Schwab like, oh, Yolanda just made some day trades, reduce her day trades. No, these are all individually tracked. So 3 here, 3 here, 3 here, and across you have 9. So that's the first way you can go about getting more day trades. The second is to consider swing trading. And swing trading, as we can see from here, doesn't count as a round trip. So this means that if you buy on Monday and you sell the next day, this is not a day trade. And there's no limit to the number of swing trades you can make. I could buy even minutes before the market closes on Monday and sell first thing in the morning. Because this was held overnight, this is automatically a swing trade. And I can do as many as I want. There's no limits to how many swing trades you can do. Unlimited. The third option is a method I came up with called the 25K buffer. And the way this works is if you're trading just with, let's say, 3,000, the goal here is to deposit 25,000 into your account only to get you above that threshold of 25K. The way the strategy works is you are to continue trading with that 3,000 which you initially had, and this is only here to get you unlimited day trades. And with unlimited day trades, this means you can buy and sell every minute if you wish, every hour. There's no limit at all whatsoever. And the fourth option is to using a cash account. What is a cash account? You have 2 types of account when you do open your brokerage account. You can opt to go margin or opt to go cash. With margin, this is the one that the PDT rule actually exists. And again, this is 3-day trades for every 5 business days. An advantage here is it allows for instant settlement. So if you buy on Monday, say $300 worth of options, and you sell it for $400, this $400 can be used immediately to buy something else on that same day. But with a cash account, if you do the same thing, you have to wait till the next day to be able to use that proceeds. So that's the downside of a cash account. But the upside is there is no PDT restriction. You can trade as much as you want until you hit your account balance. So if you are trading with $1,000 here, and you just traded with 300, guess what? You still have $700 to trade that day. So you can trade again with 200 out of it. And this means you can still trade with 500. The thing here now is that if you trade with the remaining amount, 500, now you have to wait till the next day for everything to settle to be able to trade. So cash accounts need a 24-hour settlement period, but there's no PDT restriction. It means you can trade as much as you want. Margin account does have instant settlements, but you're limited to 3-day trades for 5 business days. So for starting out, I'll definitely like the cash account because 1, the lack of PDT restrictions, which allows you to trade as much as your balance, and 2, when you're done trading, it takes away that FOMO of you rushing to another play. So once you're done, you're done. And if I go to this, for example, to give a better example, if you start off with 1,000 here and you trade it with 500, you can still trade. I don't like 500. You trade it with 400. Now, because you've traded with 400, you can only trade the remaining of that day with $600. And then the next day, it starts again at $1,000, and you can trade again. Well, if you did the same thing here with the margin account, this is already counting as 1-day trade. And then the next day, you only have 2 day trades left for the rest of the week. So if I day trade here and day trade here, I can't day trade Thursday and Friday. But with a cash account, I can still day trade every single day. I'm just limited to how much I have in my account. So once you run out of that amount, you have to wait for the next day for it to reset. So that's kind of how the cash account versus the margin works. You're always allowed to switch from margin to cash if you decide you prefer one over the other, but I would definitely advise going with the cash account to avoid that restriction on day trading. Any questions here? Cool. So now let's go into the technicals. We're going to start off with support and resistance and show how that applies to our chart, helps us with our entries as well as our exits. What is support and what is resistance? Support represents a low level, a stock price which is over time. Write this down. This area is where buying pressure exists. Support represents a low level, a stock price which is over time. This area is where buying pressure exists. On the flip side, resistance represents a high level, a stock price which is over time. This area is where selling pressure exists. Now, what exactly does that mean? Let's look at our chart below. Let's take this as our stock chart, candlestick. Let's call this Amazon again as our ticker. And let's assume that this is a daily consistency, and this is over a time frame of 3 months. First, how can we identify this support level in this chart? As you can see, we have our candlesticks. This is bullish, this is bearish, and we have our mix of our bullish and bearish candlesticks throughout the chart. With support, the definition is what again? A low level, a stock price, which is over time. So if you look here, where is our low points in this chart? Our low points are down here. Once we identify those points, we draw a circle there, and we proceed to draw a line, straight line through those points. So this line is called my support. For resistance, we do the same thing. We identify those high levels in the stock chart, draw a straight line through it, and this is called my resistance. And you are a trader in the market, you're looking at this Amazon chart. Where would you want to enter into a trade if you wanted to buy calls? Would you use support or would you enter at resistance?
You say support?
Why?
Because there's potential to go up in terms of the price.
Perfect. So you definitely would want to enter your calls as support. One, you have a higher probability of profit because you've looked at the history of this chart and you've seen that, well, every time it got to support, it bounced off that level and went higher. It happened here again, and it happened here again. So you want to look at those trends. So by me buying at support here, that gives me a more calculated risk compared to just randomly buying at any point. Like, oh, I just want to enter a call because I feel like it. No. This gives me an edge. Being able to chart and read my candlesticks is I'm able to get better entries and a higher probability of profit. Also, at this point, I'm able to get it for cheaper. Because if this is 140, and let's say this is 130, if I enter here for calls, based on the exercise we also did yesterday, and the price, let me use this. I enter here, and the price goes up to 140. Are those options the same value now compared to when it was at 130?
No.
No, because if you bought in here, let's say $100, whoever is trying to enter in here is not going to be paying $100 for sure. I can tell you that. They're going to pay way more. So this gives you a lower cost of entry by getting in at that support level. Oh, oops. Okay, and if you wanted to sell, where would you want to sell? Support or at resistance?
at resistance.
Yes, because if you are in this trade, you got in a calls down here. You've seen that time and time again, when the price gets to this resistance level, the price got rejected. Here again, the price got rejected. Here again, the price could get rejected. So looking at that trend again, if I enter here at support, I would be comfortable selling at resistance or near resistance at least to maximize my profit in that trade. So entries at support is a takeaway from this, and exit at resistance for calls. If you're playing puts instead, your entry for puts will be at resistance, and you want to exit here at support. So those are the main takeaways from support and resistance. And you will see different support and resistance levels times coming up shortly. Even though we did say yes, we're able to get out at the resistance here, there are some times where the price can actually shoot past resistance. We'll cover that scenario in RSI once we get there. Another thing to keep in mind is when the price bounces back and forth between resistance and support, this is called accumulation or consolidation. And this is very important when we get to the patterns. So just keep that term in mind. Accumulation and consolidation is when your price bounces back and forth between support and resistance and doesn't break out of that range. It just stays in this trading range. We looked at a specific type of support just now, and if I look at this chart here, I can see 3 different zones. One here to the left of that line, and then another one to the right of this line. On the left here, this is in an uptrend. In the middle, this is sideways. And on the right side, this is in a downtrend. If I look at the uptrend side, is it possible to draw a support line on this uptrend? Because we just looked at the sideways one, that looks something like this. This was resistance and this was support. So even though this side isn't flat on the left side, am I still able to draw support and resistance in that region?
Sorry, are you still able to what?
Draw support and resistance on this left side.
Yes. We'll just have a upward incline with it.
Exactly. It's going to be an incline. So same definition still holds true, is support represents a low level in stock price, which is over time. This doesn't necessarily have to be a flat level. This could also be an incline. So if you look at this, where are my low levels on this uptrend? I can see one here and a few more right there. So just as we did for that previous example, we're going to now draw a line through those points. And that line there is my support. I can do the same thing for resistance. Identify the high points And that line through that is my resistance. So here is support, here is resistance. As a trader, how can I take advantage of this trend? I can enter calls here, ride the wave up, and sell here. I can rinse and repeat again, and sell here as well until the trend stops. Same thing on the downtrend side. This is 3. This part here is my support, and this is my resistance. So just like the previous example, I can buy calls here and sell at my resistance.
Question: would you buy or put or calls on the downtrend, or
Which one would you do?
I would buy? Okay, I see where calls would be on the up, but put would be on down. Again, okay.
Yeah. So puts, I can enter puts here. Write that wave down, and then sell those puts here. Which one would you be more comfortable doing, calls or puts? In this downtrend area.
I would say puts.
Puts, exactly. Since this isn't an overall downtrend, I would be more comfortable entering puts. And you can also always take short-term calls in between, but puts as the overall direction. Likewise, if I was looking at this uptrend, I would definitely be more interested in calls, since that's the overall trend. And then I can take some short puts in between, but definitely a lot more comfort in the calls. Does that make sense?
Mm-hmm.
Okay, we took our break already. And then the next topic is trading patterns.